Good morning, everyone. Today's session is about one of the most operationally critical part of any tax practice, tax deducted at source, or TDS. Almost every client you advise, whether an individual, a firm, or a company, either deduct TDS or has TDS deducted from their income, sometime both. In Income Tax Act 2025, significantly reorganized and modernized the TDS framework. Our goal today is not just to understand what has changed, but to understand why it has changed and what it means for your day to day practice. Let us begin from the very foundation. What is TDS and why does it exist? Before we get into the new law, let us make sure we are all on the same page and about the basic concept. TDS, tax deducted at source, is a mechanism of collecting tax at the point of payment. Instead of waiting for the recipient of income to file tax returns and pay taxes later, the law requires the person making the payment to deduct a portion of that payment upfront and deposit it with the government. A simple example of it is a company pays rupees 1 lakh to a consultant. Instead of paying the full amount, the company deducts, say, 10% is that 10,000 rupees and pay 90,000 to the consultant and deposit 10,000 with the government. The consultant then claimed the credit of 10,000 rupees when filing their return. Why does this system exist? It ensures a steady flow of revenue to the government throughout the year, not just at the end of the year. Number two, it brings more transaction into the tax net, making it harder to conceal income. Number three, it creates a proper trail. Every TDS deducted generates a record, making verification easier. The structural foundation and the key concept you must know. The tax year, as you already know, the 2025 Act abolished the old previous year oblique assessment year duality. Everything now happens within a single unified tax year. For TDS, this is a significant practical improvement. The TDS you deduct in a tax year is credited against income of the same tax year. The TDS certificate issued to the deductee carried the same tax year reference that they use in their return. There is no more year shift, no more explaining to the client why TDS deducted in 2024-25 appears in assessment year 2025-26. The bottom line is one year, one set of record, one credit, clean and simple. Who are the key parties? The parties under TDS are as under deductor. The role of deductor is the person making the payment responsible for deducting any deposited TDS, also known as payer. Second party is deductee, the person receiving the payment. TDS is deducted from their income. It is also known as payee oblique the recipient of income. Government. Government rule is of the receiver. The TDS deposited credit it to the deductee's account. It's also known as tax authority. The deductor carries most of the compliance's burden. They must deduct correctly, deposit on time, file returns, and issue certificates. Failure at any of these steps attract penalties and under the under the Act 2025, those penalties are more clearly defined than before. The threshold limit. TDS is not triggered on every single rupee paid. Each category of payment has a threshold limit, a minimum amount below which no deduction is required. Why does this matter? It prevents the system from being burdened with microtransactions. Only payments above the specified threshold limits attract TDS. Under the 2025 Act, these thresholds have been moved to schedules, which means they can be revised by the government without amending the main body of the law. Keep watching for schedules update, especially at the budget time. The thematic category of TDS. This is where the 2025 Act shows its most visible improvement. Instead of scattered sections, TDS provisions are now organized by the nature of payment. Let us talk through each major categories. Category 1 is salaries, the employer obligation. Who deducts? Every employer paying salary above the basic exemption limit. The core rule: an employer must estimate the total salary income of each employee for the tax year, apply the applicable slab rate, and deduct TDS in equal monthly installments. Key reform under the 2025 Act. PAN Aadhaar integration. This is now the single source of truth for employee identity. If an employee's PAN and Aadhaar are not linked, higher withholding rate apply automatically. Full digital reconciliation. The employer's TDS return and the employee's Form 26 AS/AIS are now electronically reconciled in real time. Discrepancies are flagged before they become default. Investment declaration. Employees submit investment declaration digitally. Manual paper submissions are being phased out.